Contrast that with a carefully crafted insurance contract that we're talking about as a cornerstone for your private banking strategy. There is no penalty for taking money out early. There's no penalty for taking it out too late. And most importantly, there's no taxes. There's no taxation on your money in or money out as from this policy. Of course, you pay taxes on income, but once the money is inside your policy, inside your private banking system, there is no taxation. And that's why folks that use this for centuries, and we're talking about, John F. Kennedy, we're talking about Pampered Chef founder, we're talking about Ray Kroc, who established McDonald's, J.C. Penney's, some major brands that every American knows. Those companies were started with the private banking strategy and the whole life insurance contract in place.
Okay. Maybe, in your book, your ebook, you talk about how banks use money and the flow of money as a foundation to understanding this strategy. Can you go into that a little bit so our viewers can understand?
Sure, I'd love to. So, like I said, in the 70s, Nelson Nash brought what he coined the infinite banking concept, which is the use of a whole life insurance contract to serve as a banking system for your family. Well, branch banking became very big in the 50s and 60s, where you effectively have a neighborhood bank, things that we know today as Wells Fargo, Bank of America, Chase, US Bank, all those brand name big box banks, which are on every corner, and they make it convenient for you to deposit your money. Well, those banks are regulated by certain laws, and they're able to do what's called fractionalized lending. And fractionalized lending means that if you or I bring in $100,000 into that bank, that they are able to take a reserve, a piece of that, and we'll call it 10%. But large banks who have more deposits than others are able to actually reserve less than that. So they take that $100,000 that you deposited, and they effectively only keep 10,000 within their walls, so to speak. They loan the other $90,000 of your money out for someone to go buy a home or a car or a business loan. And they're making interest on money that they effectively never earned. You just decided to put that money there. Well, that's called fractionalized lending. And it works so long as you come in and you need your $100,000. So they scrape together 10 other people's $10,000 that they had reserved, and they give you that. But if all the people, all those 10 people come in and want their money back, that's called the bank run. The bank is insolvent. And unfortunately, that's a bad economic policy for you and I, and a bad place to keep money when your bank effectively fractionalizes our deposits and we don't have the money there. And you may recall in 2012, there was a financial collapse in Cyprus, and there were bail-ins. The bank actually bailed in on the depositors' money, and that was an authorized, legitimate, legal way for them to operate. And people go, well, that will never happen in America. It actually is, it's already laws on the books, and it's called the Dodd-Frank Act, and misnamed, in my opinion, as a Consumer Protection Act, because it does nothing to protect you or or the public at large deposits. And effectively, the Dodd-Frank Act, what it does allow banks to do is to take the deposits, of cash on hand and effectively become solvent. And in return, you get perhaps bank stock, or you may get pennies on the dollar, and that's your exchange. Well, next issue that comes up always is FDIC. What about FDIC insurance?
I was going to mention that, yes.
So if you've got, more than $250,000 in your particular account, that's the ceiling for FDIC insurance. But if you actually dig into the solvency of the FDIC, you'll see that there's not enough assets on the FDIC. And this is published information that anybody can research. And they have about 25 billion in assets as of the end of last year, 2022. And there's about almost $20 trillion worth of deposits in American banking institutions. So you've got 20 trillion deposited, and you've got 25 billion that's allocated to insure that 20 trillion. You and I don't have to be mathematicians to see that that doesn't add up. There's not enough assets in the FDIC to actually make good on the insurance of those deposits. In fact, it's less than a penny per dollar. So that's, that's quite shocking when you begin to dig into that. And some people go, well, do I really believe that? Is that even possible? Well, I'd sent you a clip from an FDIC committee meeting, which those folks were roundtabling the very issue that we're discussing.
Just a few months ago, yes.
It's quite shocking, that there's a roundtable of FDIC bankers and a special committee, and they're discussing the
crisis mode.
Yeah, they're in crisis mode, and they're discussing the insolvency of the FDIC and the potential catastrophic economic policy that's been created with the printing of money and the inability to insure those deposits. And they're saying things like, we want to control the narrative. We don't want the public at large to understand the potential collapse of the banking system. And they want to control the narrative in the social media. They want to control the narrative in the mainstream media to put people at a false ease and thinking that your money's totally safe and completely insured. And if you've got your thinking cap on, I think most people will agree, it's not a safe place. And there are alternatives. You don't necessarily have to play in that sandbox, and you can create your own banking systems where you've got more assurance and safety.
I mean, putting the potential collapse aside and not being insured for your money, putting that aside, even leaving in the bank money in the bank with the low interest rates makes no sense.
Of course. Yeah, you're not getting paid anything to keep your money sitting there at the bank.
Absolutely. So can we talk about private banking, your system that you advise your clients on, and how that relates to real estate investing? What are some of the things we can do with that?
Absolutely. One of the pillars of private banking strategies we call the velocity of money. And that's putting your money to work and actually getting multiple touches on the same dollar, being able to use the same dollar more than once. And it doesn't work in any better format or structure than real estate. Real estate is a perfect hand in glove way to use private banking. And let me just illustrate that to you for a moment. So let's say that you capitalize your private bank with $100,000. And just for the simplicity of the example, you funded your bank. Let's call that a new business, a banking business with $100,000. Now you want to take a loan out of your bank and go purchase a piece of real estate. So you borrow that $100,000 out of your bank, and you go and you acquire an income producing property. Let's call it a duplex. Okay. Mm-hmm. A little duplex. And let's say that it spends off $1,000 a door. So $2,000 a month or $24,000 a year. Okay. You bought this property, a duplex, you've got renters, and you're making $2,000 gross a month. At the end of the year, and we're not going to analyze all of the various maintenance and
the debt service.
We're just going to keep the gross numbers on the top sheets just for a simplistic understanding. You take that $24,000 and you begin to pay down your bank's loan. And so remember, you're the bank and you're the borrower. So you're not only making money inside your policy where you borrowed the money, and it's compounding and growing tax-free. No taxable event taking the money out or putting it back in, no matter what interest rate that you charge yourself. You can effectively crank your interest rates up, and you've got more growth potential. And that money in there is available at the end of the year. You've paid down 25% of your loan at the end of first year, and you've got this income producing property still spinning off 24,000 a year. Well, at about the end of 4 years, you've paid your bank totally back. And so you've got 100,000 plus the compounding growth, plus the interest and dividends that are paid on those sums, which we'll call it between 6 and 7% per year. And that's tax free. So compare that with other investments which have a tax event, a tax liability. This has no tax liability.